I get this question all the time. How do you know how to analyze, evaluate a growth stock? Stay tuned to find out. All right, guys. So today we're going to talk about how to analyze, how to evaluate growth stocks. Now, specifically, I want to focus on SaaS, that's software as a service, and cloud growth stocks. I'm going to give you three different formulas and examples today. The first two are exclusively used for SaaS and for cloud stocks. The final example you can actually use for any type of stock. So please stay tuned. Okay, so the first approach is called the Rule of 40. And you might have heard it from my channel. Maybe you saw it on our Facebook group. Maybe you saw it somewhere else. But the basic concept of Rule of 40 is revenue growth plus profit margin equals at least 40%. But it can be a little bit tricky because there are different ways to measure the Rule of 40. And I'm going to show you what I mean here in a minute, so stay tuned. Now, this has gained a lot of momentum as a high-level gauge of performance for software businesses in recent years, especially in the realms of venture capital and growth equity. So when you're out in Silicon Valley and you're looking at venture capitalists, they're using this Rule of 40 a lot of times for the new IPOs, so it's very important. Increasingly, software industry executives are embracing the Rule of 40 as an important metric to help measure the trade-offs for balancing growth and profitability. Again, best for SaaS businesses, the software as a service. So there's actually three ways that you can beat the Rule of 40, and companies can actually beat the Rule of 40 at any stage in their life cycle. A lot of people don't realize that. They think of only number one, which is strong growth. Now, with strong growth, basically you're in the hypergrowth mode. You're trying to build a large install base, displace legacy vendors, and attain the holy grail, becoming a platform. So think of Fastly trying to be, they're the best of the breed, and they're trying to be the go-to for edge cloud computing and CDNs. And it's one of those things where once they get beyond $1 billion in revenue, they have to evolve their operating model and process maturity to handle the complexities of serving multiple customer segments with multiple products across different countries, different languages. And as growth slows, mature software companies look for ways to generate more revenue from existing customers, so expand their footprint while becoming more efficient to increase profit margins and maintain performance that beats the Rule of 40. So these are the hyper growth, the strong growth, where the profitability might actually be, negative or, very low, but their growth, year over year revenue growth is very, very strong. The second way that you can beat the Rule of 40 is through a balanced, profitable growth method. And half the companies actually that consistently exceed the Rule of 40, they usually do it with growth between 10 and 30%. So they're making up for it with that profitability. So large established companies like VMware, Adobe, Salesforce, they successfully develop new products for markets adjacent to their core and navigated technology or business transitions. For example, SaaS to subscription models. If you remember one of the recent videos we did, we talked about Adobe and how they pivoted from an on-prem using old CDs to a SaaS subscription-based model. This is exactly what we're talking about on number two, and it's how Adobe really became what Adobe is today, and they're a profit machine because of this new subscription model, and it allows them to keep growing. Having climbed the S-curve, they must reorient the approach and reach the next R&D spending needs to reflect waves of innovation. They basically want to keep, relevant, and they have to constantly reinvent themselves. The third way that a company can beat the Rule of 40 is simply through profitability. So you think of some companies, they actually have annual organic revenue that's below 10% in growth. So established players like an Oracle, like an SAP, like a Trend Micro, they have these large, profitable flagship businesses, and their growth is stabilizing below 10% year over year. They have to turn into becoming more profitable. So they might only have, say 5% organic growth, but they might have a 50% profitability margin. And, that obviously could still get them in the Rule of 40. So these companies that they have to become more efficient, more profitable. They exact pricing power. They leverage their scale and scope for these large sales forces. I always think of Oracle just because I used to work there. They cross-sell, they expand, they acquire other businesses to be able to expand their revenue that way, but increase profitability. And that's kind of what you see with these large established players. It moderates their R&D investment. Something that's important to understand and is used a lot in SaaS is EBITDA. Now, if you're in business, if you're in accounting, you know what this means, but let's just do a quick recap. So this is net income plus interest plus tax plus depreciation and amortization. So you could measure profit in a SaaS business or really any business in a lot of different ways. There are plenty of options. You can use operation income, you can use net income, free cash flow, lots of others. But the most well-known and most used metric for startups and for SaaS companies is going to be this EBITDA. Earnings before interest, taxes, depreciation, and amortization is a way to measure profits without having to consider other factors such as financing costs, interest, accounting practices, depreciation, amortization, and tax tables. All right, so what are some examples of the Rule of 40? This is obviously very important. Again, recap, revenue growth plus profit margin equals at least 40%. So we want a minimum of 40 when we're evaluating these SaaS companies. Let's look at DocuSign. And this is one way to do it. There's a lot of ways to do the Rule of 40. This is where it can be a little bit tricky. And at the end, I'm going to explain why using something like the Rule of 40 is not a one-size-fits-all approach by any means, but it can help in a lot of different ways. So here's DocuSign, and this is comparing the revenue growth percentage year over year from 2018 to 2019. So you have a 39.9%. Now the profitability margin, they have an EBITDA excluding stock-based compensation. That's the SBC. And you can see that's 3.5%. So if you look at that bottom chart, the Rule of 40 growth margin, the one that's highlighted, that's circled. So the growth plus the EBITDA excluding stock-based compensation is 43.4%. So obviously that fits the Rule of 40. But now you look at growth plus, say, just EBITDA on its own, and it's 27.3%. You say, well, what does this mean? How do I know which to use? And that's where it can be a little bit tricky. There's more to it than just a simple formula. If it were that easy, everybody would just be plugging numbers into these formulas and making buku bucks. It's not quite that easy. It's simply a tool to kind of gauge how a company is doing and maybe the direction that they're going. There is no right or wrong answer or measure of profitability to use here. All of the above are valid measures, but each tells a different story. Some measures of profitability are more conservative than others and can make a meaningful difference in determining whether or not a company's performance would land over or under the 40% benchmark. As we can see above with DocuSign, the choice here can shift the Rule of 40 profitability contribution from a positive 13.7% cash from operations to negative 17.6% for operating income. So the point here is that you have to be very clear about what you're saying. So up next, I'm going to look at Datadog, and I'm going to use the quick and dirty method. This is basically what I use most often, and I call it the quick and dirty method. It's just the simplistic method. So now this picture here on your right, this is, if you go into Google and you just type in DDOG, stock, it's going to bring up an actual screen, and you can pull this, click the financials. Let me just show you what I mean real quick. So you can go into Google and just type in DDOG stock, right? And it's going to give you this here. So this is going to give you Datadog. It's down 5.92% today. It shows you all the information. Now, if you're on a phone, you won't have to do this. On the phone, it'll just already come up. But if you're on a desktop like this, I had to click more information. And then over here, you click, let me just zoom in so you can see this. Over here, you're going to click financials. And this screenshot right here, this is what you're going to see on the slide deck. Okay, so we're back at the slide deck here. And you can see the revenue on the right side year over year is 87.36%. Now in this example, it's going to give you the quarterly year over year, which isn't quite as impactful, but sometimes it can actually help you when you're making decisions, because if you're using the annual year over year, that's obviously the best way to do it, but you might miss the boat. In other words, if you wait till 2021 and compare 2019 to 2020, it might have already run up, 60%. So a lot of times when I'm buying a stock, this is the quick and dirty method. I'll just look on that, I'll do that quick Google search. I'll look and say, okay, 87.36% year over year. Net profit margin is 4.94%. Obviously, if you add that up, it's over 90%. It's blowing the Rule of 40 out of the water. So I use this as an initial scan. It doesn't mean I just go buy the stock because I did this quick and dirty method. I use it as an initial scan to find the potential stocks I might buy. And then, of course, I research deeper from there and I make sure that it's a good fit. Okay, so the second method that I use, and it's actually, if you watched the WCLD video, the #1 growth ETF, that's the Wisdom Tree Cloud Computing ETF. They actually have a venture capitalist that use what's called a grit score. And I think this is really, really cool. So you can see on the top, you've got growth plus retention plus in the bank plus targeted spend. It's acronym GRIT, and it gives a grit score. Obviously, you can see that on the right in the middle. The good is a 3 to 4 score, the better is 4 to 6, and the best is greater than 6. And I went through this really quickly on that WCLD video. If you haven't seen that video, take a look at that and check it out. So the growth on the far left side, this is the percentage year-over-year growth in annual recurring revenue. Of course, a baseline measure for the pace of a business growth. You want that number between 50 and 200%. Up next, you got the retention, which is the percentage of annual client net retention. So successful companies retain clients and achieve a rate above 100%. They sell more to clients as their businesses scale, they expand their footprint. You want that number to be between 80 and 150%. In the bank, that's the number of years of cash on the balance sheet, okay? So companies should maintain a cash buffer for growing opportunities or as a contingency in a downturn like we just had, with COVID. We had companies that are going to go out of business because they didn't have any cash on their balance sheet. Some of them were able to borrow money, some of them weren't, and that's it for them. You want that between 1 and 3 years for a healthy company. And then the targeted spend, you want the spending efficiency score, and that's a measure of growth, of revenue growth relative to cash spend. Overspending to achieve top line growth is not sustainable. So you don't want to obviously overspend just to achieve top line growth because it's not going to be sustainable and you're going to go out of business. You want that spending efficiency score between 0.5x and 1.5x. Now, this is a much better way to measure a company and the health of the company versus the Rule of 40 because there's a lot more that goes into it, as you can see. The grit score is calculated as the sum of the following metrics: year-over-year percentage change in annual recurring revenue. You'll also hear that called ARR growth. So if you've listened to any of the Splunk earning calls, the last couple, they've really been hammering home ARR growth. And that's why the stock's done so well, because they're achieving very good ARR growth and they're having huge cloud increases, like 80% year over year. The percentage of clients retained year over year is called the retention. The number of years of current level of cash on the balance sheet, we just went over this, would cover projected annual cash rate of expenditures. Again, that's the year of cash on the balance sheet. And the sum of the year over year percentage change in recurring revenue and the ratio of free cash flow to revenue, or that efficiency score. So as an example, a company with 50% ARR, 100% retention, and 2 years of cash on the balance sheet, and an efficiency score of 100% would equate to a grit score calculation of 0.5. So that 50% ARR, you're using 0.5. 100% retention is just a 1, okay? The 2 years of cash, of course, is 2, so you add 2. And then 100% efficiency score is just going to be a 1. You add those together, you get 4.5, and it's going to be in the better category. Again, here on the right side, better is between 4 and 6. Now, the source is from Wisdom Tree, from the WCLD, but also who helped them create that is called Bessemer Venture Partners, also known as VBP. So they call it the VBP index. Any stock that's in WCLD has to go through this process and have a score of at least a 3 in order for it to be chosen as a stock that's going to be held in the portfolio. The thing that I do want to note on this is that the grit score is, again, it's something that Bessemer Venture Partners created in 2019. It's not something I even knew about before I did the WCLD video. I found it in that slide deck. So I'm not trying to take credit for the grit score. I actually use something that's very similar to this. One thing that I never really looked at was that efficiency score. I've always looked at the first 3 columns. You got the growth, the retention. That's always important with subscription models. And then, looking at the balance sheet. But I never, really went into it and looked at the efficiency score. So really, if you think of grit, GRI is what I've been using. I use a combination of the Rule of 40 and essentially the 3 components of GRI. This T on here for the targeted spend, this spending efficiency score is very valuable, and it's something that I'm now incorporating when I do further research. The third method that you can use to evaluate stocks, and you can use this for any type of stock. It can be a growth stock, it can be a value, anything. This is important. You've probably heard of a SWOT analysis before. Obviously it's looking at the strengths, the weaknesses, the opportunities, and the threats. And that's important anytime you look at a stock. Formulas, the reason I'm bringing this up is that those first 2 formulas I gave you with the Rule of 40 and with grit, those formulas are not one size fits all. Now, if I were going to use a formula and call it, the closest thing to it, it's going to be grit. But you're not just going to, find a company that fits all those metrics and buy it without researching it further. You're going to look into the leadership. You're going to look into macroeconomic conditions. You're going to look into all kinds of different things. Make sure that the products are good, that you have a gut feel that this company is going to do well, that the products are going to do well, that it makes sense. You can say, well, is NVIDIA going to, and NVIDIA is just an example. Obviously, it's not a cloud company, it's a chip company, but it kind of fits in this whole cloud networking because they do data center. You think of NVIDIA, are they going to be around in 10 years? They're developing, A, B, and C. Here are the growth potential. Here are the secular growth trends with autonomous driving, with data centers, with gaming, with, blah, 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 all these different things. And that part of the story has to fit in with all this other stuff. So each item is one pillar with a bunch of pillars that are used to make an educated decision when you buy an investment. So you should not buy a stock solely off of, those formulas by any means. And you need to understand the strengths, the weaknesses, the opportunities, and the threats of any investment that you're going to make, whether it's a stock or anything else. And not just on SaaS, every single stock that you buy, you want to understand the SWOT analysis. You always want to do your due diligence, and you have to manage your risk. So let's just do a quick example of SWOT analysis. Again, Tesla is not a SaaS company. You would not use Rule 40 with it. You would not use grit with it. This is for SWOT analysis, the third method, and it can be used for any type of stock. This is just a cool slide that I wanted to show with Tesla, showing the SWOT analysis. So in your top left, you've got strengths, unique position in the auto market with robust sales growth. You've got the opportunities, which is, actually the weaknesses. Let's go in the order here. So W, you've got the weaknesses, which are burning through cash. You got high debt load. For the opportunities, you've got the Model 3. You've got trucks, the cyber trucks. You've got cost reduction initiatives. And for threats, you've got, funding for scale. You've got competition. You've got, there's probably a lot of other threats that you can name in there. But this is just a really quick, high-level example of how you would, do a SWOT analysis for a stock. All right, so my final thoughts on this. Every type of stock has unique ways to determine value. So what do I mean by that? So if you're a value investor, when you're looking at a value stock, you're going to have a completely different approach. Obviously, you're not going to try doing a Rule of 40 or anything like that. You're going to look at completely different metrics and financials when you're determining value. With that said, you can use SWOT analysis on any type of stock, as we mentioned. So today we discussed high growth, SaaS, and cloud for the first, two examples. Not all stocks are created equal. So, how you put a value on Amazon versus, Marriott versus Nike versus Microsoft, they're all different, and there is no magic bullet. So I can't say, hey, for this type of company, and even how you measure a company, is Amazon, they have it categorized as consumer discretionary. Do you consider Amazon consumer discretionary, or do you consider it a tech company? I think it's a tech company, but that's not how it's categorized. So, if you say, well, all tech stocks you measure this way, well, heck, Amazon would be measured by consumer discretionary, and the PE ratio is astronomical. So there's a lot that goes into stock investing, and a lot of it is going to be, secular growth trends and gut, and you use these different approaches and methods and valuations. A company might have a PE of 5, but if nobody's buying the stock and it doesn't have any, it doesn't have any growth potential, it doesn't have any, maybe you're buying it for dividends, and that's totally fine. But you're not going to buy, a stock that doesn't have a dividend that's a 5 PE ratio if you think that the company's going to close its doors tomorrow. You're not going to go, buy JCPenney. You might buy JCPenney because you think Amazon's going to buy them, and you're kind of, it's kind of a gamble, roll the dice. But you get my point. You're only going to buy a company that you believe in, that you think is going to perform well, that's going to continue to innovate, to grow. And all stocks are created differently. Each stock has its own unique risk and reward. You need to understand and be diversified and have different valuation strategies for each types of buckets or stocks. If you're not good at doing this, master one and use ETFs for the rest. So, for me, I invest in lots of different areas, but technology has been my strong point for over 20 years. I've been investing, and that's where I've made the majority of my profits. Other things I've done well in, Nikes and Home Depots and Costco's, it seems pretty straightforward, but, I was buying them 5-10 years ago, so they're worth a lot more than the original investment. And you can say, well, that's not rocket science, Eric. You can just buy and hold anything and it'll do well. That's not true. Go look at Macy's, go look at JCPenney, go look at a lot of different stocks, so when the story changes, you got to be able to sell and you got to understand. But what I'm trying to get at if you're really good at one sector, say you're a master of REITs or you're a master of technology or whatever you're really good at. And that's, for me, I work in the technology industry, so I feel most comfortable. I feel most educated. I'm kind of in the know of what's going on with different types of strategies, different types of technologies. And I feel comfortable and confident investing in those companies. For areas like aerospace and defense, I use ITA a lot because that is, that's an aerospace and defense ETF, and I don't have to try to guess which aerospace and defense company is the best. And there's some other examples like that too. You can buy a consumer staples, ETF. You can just buy the VU and cover yourself that way. But be diversified, and if you're not good at picking individual stocks, leverage ETFs to fill in that diversification, and make sure you have lots of different types of buckets of stocks and sectors. They call it the barbell approach. When you look at the stock market, last couple of days, you've had a rotation from high growth to value. And if you had all high growth, you just had Adka and Fastly and Shopify, you've done great if you've owned them for, the last couple of months, but today you got clobbered and you're down on your portfolio. Where if you look at the value picks, the Dow, people are buying those stocks. There's a rotation. There's always constant rotations of money from different sectors. So you're seeing a rotation from growth to value, and you're going to see that. So it's important to be diversified and to not just own one type of stock, because there's going to be days where you're going to get absolutely clobbered. If you haven't visited the website, it's firedupwealth.com. I encourage you to go take a look at that. And then we also have a Facebook group. So there's actually a public page, just, Fired Up Wealth. You can go into Facebook and do a search. And then there's also a private group, and you can go ahead and apply for that private group. We've got about 2,000 members in there. We have lots of Q&A, and I encourage you to join. Thanks for watching this video. I appreciate your time and attention. Have a great day. Take care.